Let's get across the market open now. Kyle Rodder joining us from Capital.com. Kyle, welcome to Thursday. Good to catch up with you again. So, goodness, we look at Wall Street. New records for both the S&P and the Nasdaq. Investors very much in risk on, and they're seeing that optimism that those talks are going to resume between the US and Iran, and the war is near an end.
That's exactly what the market's betting on, and it's been a remarkable rally. And you really can't sort of refute or argue with the fact that you've got the S&P 500 on record highs, and as the old cliche goes, there's nothing more bullish than record highs. My skepticism is that the markets have been complacent throughout this war, leading into it and through its initial stages, and that this might not be a sort of one-way move necessarily, and that we could still see either the ceasefire breakdown or a deal not being reached, conflict resuming. We still haven't seen the normalization of energy markets yet. There's still the possibility that we face a little bit of a cliff there when it comes to global supply over the next sort of week and a half or so, as more or less the ships that left the Middle East 3 or 4 weeks ago at the onset of the war hit the docks, unload, the energy's consumed, and there's a big black hole left behind. But for now, again, you can't really ignore what's being said in the price action, which is the market's bullish. They want to buy into the prospect of strong earnings, which also haven't really been revised down since the start of this crisis. And it's categorically a risk on. We're likely to see that persist into Asian trade as well.
Yeah, and particularly you look at, of course, first quarter earnings season underway in the States. That is, well, markets certainly perceive that as being pretty positive at this point, although we're just hearing from the banks at this stage.
It certainly is. And I mean, going into this earnings season, the risk was that if you look at the analysts' forecast for this quarter and the quarter ahead, you had, call it 13% growth for the first quarter, and then almost 20% growth for the second quarter. And there'd been very limited revisions to this first quarter's earnings, down only a fraction, largely by virtue of this crisis. And we've actually seen an upgrade in earnings growth for the second quarter. So this is kind of why the markets, I think, are rallying the way that they have, is that with the sell-off that we did get in March, we did get valuations much closer for the S&P 500 around notional levels of fair value. The question becomes, is the market again complacent and not discounting the economic impacts via higher costs, lower revenues, lower earnings because of the supply shock? If it isn't accounting for those things, then that second quarter guidance has to be downgraded, and the move that we're seeing in equities might have to be revised to some extent. The flip side of that too is that we did have that almost 10% drawdown. Maybe that does discount, that potential downside risk in earnings, that we've already moved past it. But again, I don't think it's a clear-cut case that we're in a market that is going to shoot to the moon here necessarily. One, because of the geopolitical risk, but two, at least when it comes to the equity markets, there doesn't seem to be a very tangible impact yet on the earnings outlook from this energy crisis.
What are you seeing locally here, Kyle? Look, we're obviously trying to gain as well, not as outsized as what we're seeing on Wall Street. Nonetheless, we are pushing towards those records again.
And the fact that we have had some good results from the financials in the States over the last few days has been a little bit of a tailwind at different stages for the ASX 200, which, obviously is just going to trade in the slipstream because of, passive money flowing back into stocks, but also flowing into the banks locally because of their counterparts performing reasonably well in the United States. It's pretty tried and true correlation there around these sorts of periods. So the move probably won't be quite as aggressive as what we saw on Wall Street, but still there's enough there to suggest that as long as sentiment stays solid and that we've got evidence that at least financials in one part of the world are performing okay, the big banks and the heavy lifters on our index might perform reasonably well as well. So, we're only a couple of percent away from record highs. Again, it doesn't exactly take into account, I think, the risks that could stem to the economy from this crisis, or the risk that things could fall apart once more. But nevertheless, strong lead, exactly the kind of sectors that you would want to see performing well in the States to drive a decent performance of the ASX 200. And once more, a few percent away from record highs, we might be clearing that hurdle ourselves if things continue the way that they are.
Now, Kyle, look in the macro, key data today in the form of jobs. Interesting to see how the RBA looks at these numbers, because clearly it's focused on inflation, particularly given what we're seeing with the pressure coming through from higher oil prices. How do you think they're going to interpret this? What's the expectation?
I see there basically being a bit of an asymmetry in the risk here because a bad number doesn't really change the calculus too much. A good number would more or less say that the labour market isn't any sort of impediment to raising interest rates further. And as a result, it could mean that the May meetings becomes much more live if we get a number that, the forecast is for, low 4% unemployment rate, an employment increase of 20,000, steady unemployment rate, a bigger than expected jobs increase. Labour market isn't, again, a hurdle for the RBA to hike interest rates. Inflation's going to be a problem. It already was a problem. It's going to be a bigger problem going forward because of the impacts of the energy shock. It will only provide greater impetus for the RBA to hike interest rates. Part of the reason why we've seen the Aussie dollar obviously trending the way that it is because of that. Equities are a little bit more blasé, but if we were to get a strong number, of course, we'll see that intraday volatility and lower stock prices via, the jump in yields that we'll see from strong prints. So once more, bit of an asymmetric risk. The RBA is expected to hike a couple more times before the rest of the year. The question becomes when it hikes those interest rates, and a decent number today on the jobs front will mean that the markets will probably expect that hike or that next hike to come sooner rather than later and make May, which is already a live meeting, a higher probability of a rate hike.
Now, speaking of oil, Kyle, this situation has just deepened further in terms of the crisis that Australia is facing with Viva's refinery in Geelong. There's been a large fire there, so clearly it's going to have an impact, particularly on fuel supply your way.
It would certainly seem so. And I guess this is the big lesson from the crisis is we're in a world of supply shocks and energy insecurity, and we want to be able to have much more resilience in our energy systems, however that happens to manifest. This shows that when things are bad, it's a bit of Murphy's Law that something like this compounds the situation significantly and might have direct ramifications on at least the economic performance of one part of an economy, certainly because of the interconnectedness of things, a much broader impact as well. So energy security is going to be the name of the game going forward, and something for policymakers to watch out for or take much more seriously. This just obviously compounds a situation that was already very, very precarious because of our lack of refining abilities. It just takes another thing offline that only exposes that risk even further.